Hello and welcome to the next episode of the Money Side Up podcast. A huge thank you to everyone who is joining us today. We've got plenty to unpack. It's hard to believe we're, nearly at the end of the first quarter of 2025 calendar year. Hard to believe. Time is moving quickly. We say this time and time again. But I guess before we get into it today, by way of introduction, I'm Jared Brown, based here in Singapore, and joining me today is my friend and colleague, Will Cart, down in New South Wales. G'day, Will.
Hey, Jared. Great to be here as always. Now, just for the legal professionals listening out there and anyone else, a quick disclaimer. Obviously today's podcast and all the podcasts that we put out to the world, general advice, if you want to obviously, make any changes with your financial situation, get some specific tailored advice. The information we talk about is, for educational purposes only. So ticking that compliance box, as you touched on, Q1 2025, there has been a lot going on between, the end of last year, the Australian dollar was going down quite a bit. Trump's come out with tariffs here and tariffs there and tariffs everywhere. We might touch on that a little bit, but yeah, quite a volatile quarter, I think. Obviously not only in the markets, but in the political world and everything else going on. So definitely an interesting one for us to dive into.
Absolutely. And I mean, it's always interesting. Yeah, first quarter this year, I find is always a little bit dependent on what happened last year in terms of how busy the expat landscape is. And same is true back home in Australia with Aussie residents as well. Just how motivated people are to do things. What did they miss out on last year? Obviously, Australian properties had a very good run. Equity markets, a very good run. Aussie dollar, potentially some opportunities there for expats. What are some of the conversations you're having, I guess, with Aussies all over the world?
Well, it's funny with Trump, obviously empowering the US. I have seen quite a lot of Australians talking about the idea of moving home from the US. That's been quite a common theme amongst a lot of people. Still definitely some Aussies moving over to the US, don't get me wrong, but a common theme, people reaching out saying, hey, how does it work and what do I need to consider? Whereas maybe a few years ago, it wasn't even an option that they were considering at all. But definitely still lots of global movement in the expat space. I mean, I'm sure you see it all the time in Singapore as well. That doesn't seem to be slowing down at all. And potentially it's because, COVID a few years ago really limited everyone moving around and now everyone just wants to get more in. But we're having lots of Australians reach out to move to Saudi Arabia, to Dubai, the Middle East being very popular, Europe as well. Lots and lots of people reaching out for the UK, for France, for Germany. So it just seems like Australians planning to make these moves, it's just becoming, more and more intense and more Aussies every single day really thinking about picking up, taking a new job overseas.
Absolutely. Yeah, I think you're spot on. I mean, the movement has well and truly picked up. I think everyone's trying to find that sort of relatively cost-friendly destination that is also tax-friendly. I think Singapore, maybe 5 years ago, you could have pretty comfortably lived here on a household income of maybe 250, 300. I would suggest that number today is more like 4 to 450, especially if you have, one or two children at international school. Those costs have certainly ratcheted up. So as you say, a lot of Aussies moving, Dubai, Saudi, that whole region, Thailand, Malaysia, especially if they can sort of work from home or work remotely. I think we are also seeing a bit of a push there. Hong Kong is a really interesting one. We're certainly finding that a lot of Australian expats that we're talking to there have been there a long time. The longevity there, the tenure in Hong Kong does seem to be a bit longer than Singapore. So, a lot of Aussies there for 10, 15, 20 years. Again, the tax rates there, life there, it suits them. They might be accessing Chinese markets, maybe working in regional roles. But it's going to be interesting, I think, to see maybe what happens in Hong Kong over the next year or two with, there's a lot of support for businesses relocating to Hong Kong. So I think, we're certainly watching that space very closely.
Yeah. And then even domestically, as we touched on, a lot of Aussies coming back home. Property market here has gone gangbusters. Perth, Brisbane, really leading over the last 12 months. Melbourne actually having a bit of a decline, but a lot of forecasters and analysts are saying that Melbourne's going to start to have a bit of a bounce back now as well. So the property market in Australia is really, really ramping up like it has been for the last 12 months and, will continue to continue to ramp up, it seems, and especially adding a bit of fuel to that fire is the RBA, right? I mean, very positive outlook for the next few years for interest rates here in Australia as we continue to catch up to the rest of the world that have been making cuts for quite a while. So I think that's a key piece that I'm noticing as well, is a lot of our clients and a lot of expats reaching out. I want to consider selling my property. It's gone up, a lot. What happens there? Or, I'm considering moving home in a year. We need to buy a property. When we left 5 years ago, we sold the place for $1 million. Now to buy the same house is going to cost us 1.9. So definitely a big disparity there. And it's, I think something a lot of people don't think about, that the costs to get in and the costs to get out of the market. But what's been your take, Jared, on the property market? What have been some aspects that you've noticed?
Yeah, look, lots of conversations about property at the moment. I think it's one of the most common conversations is Aussie expats always kind of hedging that move home. And it's, what if I lose my job, or what if we have to move because, the parents get older, or there's a health issue, or for some reason, it's not necessarily our decision to move back, but it's kind of pushed upon us. So for a lot of people, they're trying to get into those markets, whether it's, eastern suburbs of Sydney, or it's, the nicer parts of Queensland, Brisbane, Southeast Queensland, the region, or even Perth. Blue chip markets in Perth are not cheap. And Adelaide, I would suggest, has even joined those ranks these days. Melbourne's an interesting example. I think, obviously Melbourne's had a pretty terrible run since COVID relative to the rest of the country, and particularly relative to Perth and Brisbane, as you highlight, and Adelaide. And it's probably not a bad opportunity when we do get these sort of disparities where you can clean up what you might already hold. So, if you've got say an asset, and I'll use that term loosely, maybe a property that you shouldn't have bought, or it's just not a good investment. Studio apartment being a great example in Melbourne, no capital growth, maybe a decent yield. Maybe now is a decent time, given there's probably been no capital growth, therefore no tax bill, to just clean up, get that money into something that is going to work for you. So I'm not suggesting anyone with a studio apartment should go out and sell. Seek some advice, please. But when we don't get that strong uplift, maybe that money could be deployed better, whether into other real estate in Melbourne or elsewhere, or even other assets. But yeah, I think property is always front of mind for Australians all over the world, whether it's a house, an investment property, that leveraged growth, providing you have time on your side, is pretty hard to beat, at least as part of the overall picture.
And I think that's the key there, though, right? Having time on your side. Too many people dive into property thinking, what's this going to do in the next 6 months or 12 months? Property, you should be thinking about 6 years, 12 years, not the months. You should be really extending out that time frame when you're buying a property. What do I expect this to do over the long term? And like you touched on, something like a studio apartment in Melbourne over the long term hasn't done very much. The data shows us. Could be a good time to clean things up, to make sure that your portfolio is targeting, the growth, and it has that purpose of direction that you're actually after with your money. It's a key thing to consider. Well, Jared, we definitely have a very interesting interview today, all things US. As you know, I am a big fan of the US. I love the US, got lots of clients there, love traveling there, love the versatility of all the different states and all the rules. It's definitely something that we love sinking our teeth into here. We're interviewing Noelle from Pitcher Partners. She's an expert in US tax, Australian tax. So it's a really, really interesting interview that we're going to dive in today, and I'm really excited for it.
Fantastic, mate. Let's do it.
So crossing over to our interview now, we have the lovely Noelle here from Pitcher Partners, who's going to talk to us all things US, from taxes to Australians moving there to US people moving back to Australia and vice versa. We're going to cover off absolutely everything here. It's quite an in-depth topic. A lot's obviously happening in the USA at the moment, but believe it or not, lots of Aussies are still moving over there every single month. And, repatriating as well too. So, Noelle, lovely to have you here. First question, can you share a little bit about your background with us and how you actually became, a US tax specialist?
Yeah, sure. So I actually started my career at one of the Big Four when I was 19 and fresh out of university. And I actually came in as a summer vacationer or an intern. And at the time, the people that I was buddied with, were actually taking a free trip to Disneyland, as I like to say. But they were actually being sent to the US for training, for US taxes specifically. And so when you're 19 and don't have a lot of money, you decide that this is your gateway to travel. So that's how I kind of fell into US taxes. Stuck with it for a while and got the chance to actually move to New York and take on a short-term assignment. But then COVID happened. And so that gave me the choice to say, do I want to stay here or do I want to come back home to Australia? So decided to come back home to Australia, at which time I got an opportunity with Pitcher Partners. And so moved across from one of the big four to Pitchers, just to enhance their current US tax service offering at the moment. So been here for the last 2 years and enjoying the ride.
Yeah, lovely. Now, other than Disneyland, what else inspired you to, focus on expats and continue to work with expats after that experience?
Yeah, it's actually the diversity of, the expat landscape. So with US taxes specifically in that focus area, you've got Americans living everywhere globally. So either in the US or they've relocated to Australia for a significant period of time in the past. A lot of them were actually living in Paris. And so there was a lot of opportunity available with a highly in-demand skill set for you to specialize in cross-border taxation and specifically in US taxes. And then also the depths of the different clients that we get to work with. So not only do we get the chance at Pitch Partners to work with high net worth individuals, but we also get the opportunity to work with a lot of businesses which are expanding into new locations as well. So you do get a lot of exposure to both the corporate side as well as the individual tax side, which provides you with a lot of variety in your day-to-day life and in your career as well.
Yeah, I'm sure no 2 days are the same from, the exposure that we have to our US-based clients and, even just the tax system there. I'm sure you're, you've definitely got your work cut out for you on a day-to-day basis, I assume.
Yeah, it's definitely a busy year. Not a lot of lean times.
Yeah, fantastic. I guess, obviously a lot of our clients get very excited about moving to the US, and some of that excitement does start to wane a little bit as they start to learn more and more about US taxes. And we'll dive into some of the specifics today, but maybe at a sort of starting level, can you step us through some of the major differences between, say, the US tax system and the Australian tax system that a lot of Aussies will be familiar with?
Yeah, sure. So I think the biggest thing with the US is that it's a citizenship-based tax system. So for individuals with US citizenship or with long-term permanent residency, that doesn't necessarily mean that if they leave the country that they stop filing. Essentially, they continue having the obligation to file US tax returns regardless of where they're living. And then, unlike Australia, there are a lot of differences between how structures are treated in the US and different types of personal investment. So, as an example, in Australia, it's quite common for individuals with a lot of wealth to structure their affairs through a family discretionary trust. One, for asset protection. Number two, it also provides you with the opportunity to stream income to lower income or lower tax bracket earners. But unfortunately, sometimes if the structure's not set up correctly from the get-go, it could mean that the individual who has set it up, if they are US citizens, are just taxed on whatever's in the trust. So there's a lot of differences, particularly in the way that different investment vehicles are treated. I think at the moment, trusts seem to be the most topical. There's a lot of IRS audit activity with them as well, particularly if they're not US domiciled ones. So it's probably worthwhile connecting with a dual advisor prior to setting up any structures if you do hold US and Australian citizenship.
As with most things, seek advice before you set things up. That would make everyone's life on this call, and I'm sure everyone in this industry, much more pleasant. Sadly, not always the case, but I think that's really good advice. I guess maybe, you touched on a little bit of the differences around different structures, etc. Again, just at a headline level, so for an Australian working in the US, what are their tax reporting obligations to the US?
Yeah, so the US actually has four different levels of tax. So they have the federal tax system, they have the state tax system if you're living in a state that levies state taxes, They have social security taxes and sometimes even city taxes, like in New York. So the fundamental thing to be prepared for if you are an Aussie relocating to the US is just understanding the layers of taxation, and also being aware that sometimes the states do have a lot more license to levy taxes than the federal government has in some respects. On top of that, the US is also quite focused on non-US domiciled investments, specifically wanting to know a lot about an individual's holdings in assets that aren't domiciled in the US, and also foreign financial accounts as well. So there's a lot of disclosures for non-US citizens and Australians relocating to the US, to provide the IRS and sometimes even the US Treasury with a bit more information about any assets and investments that they hold outside of the States.
I think that's such a pivotal point, right? A lot of people don't understand the differences in our tax system and theirs. And obviously in Australia, if you live in, Brisbane or Sydney, your income tax is the same. But like you said, in the US, if you're in a state with no tax like Nevada compared to somewhere like New York, it's going to be vastly different, the amount of tax that you pay. So deciding, where you're moving to can be a pivotal thing for Aussies planning to move. But is there anything else that you think, Australians planning to move to the US should really think about from a tax perspective before they go?
Yeah, I mean, like we said, definitely invest in getting the advice up front. Oftentimes you can find dual qualified advisors that will provide you with pre-relocation tax consultations. It could be as simple as, for example, looking at what your personal investments that you hold at the moment are and whether or not it's worthwhile to keep those or liquidate those. And also understanding some of the challenges with different, pension systems as well. So, for example, Australian superannuation is the one that comes up quite frequently for individuals that are relocating from Australia to the US. It's not actually viewed by the US as a qualifying deferred pension. So what that means is that any contributions that go in there from your employer, it's essentially just viewed as additional compensation and wages that you get from employment as well. So there are particular nuances with the US tax system that you just want to know upfront. Like I said, pensions is one of them. I think personal investments in things such as non-US domiciled ETFs and managed funds is also another big one. They're more punitively taxed from a US tax perspective than Australia would look at them. So again, getting the advice up front is probably most worthwhile. Yeah.
Most definitely. And then obviously when Australians, have made the move to the US, they're starting to settle in. How do they navigate, the dual returns they have and both obligations in countries? I mean, do you find that a lot with your clients that people find it very difficult to navigate that? And how do you help them through that, situation?
Yeah, sure. So it's actually a lot more straightforward for Americans moving to the US. And I say that with a grain of salt, mostly because it's a lot easier to break Australian tax residency if you're able to build up your paperwork correctly and get your affairs in order. So a majority of the time, if a lot of our clients are relocating to the US for a period of at least 2 years, there is the high likelihood that they'll be able to break Australian tax residency. And so what that means is, from an individual perspective at least, they won't need to do any additional reporting and lodgements to the ATO while they're gone, unless they have involvements in things like Australian discretionary trusts, or if they have any property in Australia that might need to be filed. So from an Australian perspective, at least, it's a lot easier for them to manage their tax filings. From a US perspective, though, I think that's where the compliance and reporting gets a little bit more onerous whilst they're there. So the biggest focus, again, would probably be on things like structures. So naturally, Australia's got a 30 June fiscal year end for the financial year, whereas the US works on a 31 December year end. And so if you do have that obligation to do reporting for specific structures in the US, it's something that you'd probably want to work with an accountant with, specifically because you're going to want them to work with you and trying to build up 31 December financial year end statements that can be used for US purposes when you do your lodgements and your filings over there.
Oh, that makes sense. And I mean, I guess one of the things that we all love as Australians when it comes to tax is any sort of deductions, credits. What does the average sort of Australian expat need to know, moving to the US, whether it's, credits for tax paid or they've got property? I guess, what are some of the other, or are there any deductions or credits they should be aware of?
Yeah, I mean, the standard deduction threshold in the US, which is basically a baseline deduction that every individual filer gets, is quite generous. So, as an example, if you're filing individually or single from a US perspective, you get a complete standard deduction of $14,000. You do have the opportunity to file jointly with your spouse, and obviously that doubles the standard deduction threshold, meaning that at least 26,000 worth of your income is excluded from US tax from the get-go. Interestingly, mortgage interest repayments are tax deductible from a US perspective. So if you do have a property that has a massive mortgage on it, particularly now in an environment where interest rates are quite high from an Australian perspective, that can be taken as a deduction on your US tax return as well. So of course, there's scale downs and things just to make sure that not everybody is going to be trying to maximize over and above what they're entitled to. But it is something that is quite unique to the US tax system as well. The opportunity to take tax credits is also available. So to the extent that you do have any non-US taxes that are paid, and you're required to pay taxes in the US on foreign sourced income, there is that chance to take credits to offset any of the US taxes due as well.
Okay. So a fair bit for Australians to be thinking about. Well, let's dive into it. I mean, this is probably a bit of a complex area, but and again, we can go into as much depth as you would like here. When it comes to retirement accounts, a lot of Australians have heard about them: IRAs, Roth IRAs, 401ks. We don't need to go into exactly what they all are, but I guess what does the average Australian expat need to think about in terms of setting these up? What's deductible? What happens when they leave? What are some of the key aspects when it comes to these retirement accounts?
Yeah. So let's start with the US ones first. I think, a lot of Americans who are relocating do get the opportunity to go there because they've got an employment offer. And as part of the benefits package that they get in the US, there is that chance for them to contribute to US 401k plans, which means that they can take some of their income pre-tax and deposit that into a deferred pension plan, tax-free, that goes in, that grows over time, and it generates a lot more returns on their behalf. And then if you are an American and you're residing there, the view is that's going to be used for your retirement. So as a Aussie living in the US, by default, it's basically free cash that you get to put into a deferred pension plan. The other benefit of that is that your employer also matches your personal contributions. So that's an additional windfall for you as an individual. But the biggest sticker with that is probably what happens when you relocate back home. So if the view is that you're going to be in the US for a short period of time and then eventually transition back to Australia, set boots up here, retire here in the future, it's probably worthwhile looking at one, if you should leave that pension in there and let it continue to grow in a tax preferential environment and, withdraw it at the time that you retire. But number two, is it worthwhile pulling out now before you actually come back home? I think the biggest challenge that Australians who have these US pensions are going to come up against is the recent focus by the ATO on foreign trusts. So similarly, the US doesn't like Australian superannuation and doesn't see that as a qualifying deferred pension. The ATO has a similar view with US 401ks and IRA plans as well. There's been a lot of publicity recently, particularly on the treatment of foreign trusts and substantiating whether or not that's going to be taxable in Australia on withdrawal. And a lot of the time it really comes down to the paperwork. Can you substantiate that the contributions in there are specifically just your cost basis or corpus, and will that be tax-free? Or if you can't substantiate that, then the default position is, that's going to be fully taxable and assessable from the ATO's perspective. So it's really thinking about those longer term things and whether the strategy would be, to take out the proceeds or contributions upfront prior to relocating and reestablishing Australian tax residency, just so that you can reduce the possibility of getting additional Aussie tax whacked on it.
It's such a case by case basis too, right?
Mm.
What person A should do and person B should do might be completely different based on
Yeah.
what's in there and the circumstances, how long they've been there, all of those factors.
Yeah, absolutely.
It's funny. We had a client who she moved to Australia from America when she was 6. She's in her 40s now. She still does her US tax returns, even though she states she barely remembers living in the US at all. So when US citizens move here to Australia, how do they continue to handle their tax obligations?
It doesn't come without its challenges. So I think there's a lot of benefit in trying to make sure that you build up the team of advisors around you that have the expertise in both jurisdictions. There's no way to really avoid doing tax returns every 6 months if you do want to retain your US citizenship. So the compliance cost of actually keeping both citizenships is quite high. It's not so much the tax that's really going to impact those individuals, particularly because Australia is quite a high tax jurisdiction. So naturally, you're going to have sufficient credits available on the Australian side that you can use to offset any US taxes. But it's the timing of when you pay those Australian taxes, which is really going to impact whether or not you can take those credits on your US tax return. So if you're able to structure your tax affairs correctly, the highest marginal or global tax rate that you're ever going to pay in reality is going to be at the top US tax rate, which is 37%.
So, Noelle, how do US citizens living in Australia handle their US tax obligation?
It's actually not without its challenges. So if you do retain both your Australian and US citizenship and you're residing in Australia, naturally you're going to be completing tax returns once every 6 months. So Australia is quite generous in the amount of time that you get to complete your tax returns. So if you are on a tax agent's lodgement program, by default, the lodgement due date is on the 31st of October, but that can be extended up until 15th of May in the following year. It's not so much the extension of the Australian taxes that's really going to impact you. It's probably the timing of when you pay those taxes. So from a US perspective, the reason why that's important is because the IRS is going to look at when foreign taxes are paid so that you're actually able to utilize them as a foreign tax credit on your US tax return. So there's a bit more legwork in needing to make sure that any Australian taxes that are due and owing are paid in prior to 31 December so that you can pick them up next year when you do your US tax returns. What that essentially means for US citizens residing in Australia is that a lot of the transactions, a lot of the tax payments are going to really be in the front end of that Australian fiscal year. So between 1 July to 31 December each year, that's particularly when we'd want to look at making sure that we're making any of those prepayments, making sure that any of the taxes that need to be due and owing to the ATO are made. And if there's a requirement to do, cross-border tax estimates to cover both jurisdictions, it's really during those first 6 months of the fiscal year that you'd be looking to do them.
Now, the timing becomes so key. It's similar to here in Australia. People might sell a property and try and make superannuation contributions, and they'll think, I'll do it next year or I'll do it in a few months, realizing it needs to be done, in the same financial year and the same time.
Yes.
Now,
yes, exactly.
Another common phrase that we hear as well too, Noelle, is worldwide income. A lot of our clients always talk about this impact of worldwide income. So a bit of a double question. Firstly, can you explain what that is and what that means? And secondly, how does that affect US expat?
Yeah, sure. So worldwide income essentially reflects the income that is earned not only in the country where you're residing, but also income that's earned in other countries and jurisdictions as well. So as an example, if I'm an Australian citizen, an Australian taxpayer, but I invest in Apple shares and I also hold a property in the UK, and I'm employed in Australia, then my income essentially reaches three jurisdictions, being the US, the UK, and Australia. So worldwide income essentially means that irrespective of the country where that income is earned, then that's what's considered to be assessable. The second part of that question is, how does that affect US expats? So for Americans residing in Australia, that will influence them because the US essentially taxes on worldwide income if they're a citizen. So irrespective of whether or not they're in the US or in Australia, in the UK, in Singapore, they're going to be assessable on income anywhere in the world that they earn it.
All right. So let's dive into, I guess, one of the other sort of common questions we hear about, this idea of double taxation. You've mentioned, obviously, we've got sort of conflicting timelines around end of calendar year, July to June on the Australian side. How do American expats in Australia actually avoid that double taxation?
Yeah, so they can do it in one of three ways. So the first way, and the most common, is by utilizing foreign tax credits that are available. So what that means is essentially using any Australian taxes that have been paid as a credit on their US tax return to reduce any taxes on the US side. The second option is by way of income exclusions. So the US essentially provides individuals below a certain income earning threshold the ability to exclude any of that income straight from US taxes. So depending on how much you're earning, that might actually be the more beneficial outcome for you because you can carve out anything that you've got from employment straight from taxes in the US. The third option that's available is actually leveraging the Australia and US double tax agreement. So that essentially provides you with some tiebreaker rules and things that you can use, which both countries agree on, to see which jurisdiction gets the primary right to tax the income. So there's a couple of options to try and reduce double tax. I think the only caveat that I'd put there is, for example, if somebody does remain a state tax resident, sometimes the states won't recognize tax credits, and sometimes they won't even recognize double tax agreements. So there might still be that leakage at the state tax level, particularly for those states that tax you based on your domicile.
Any states that we should stay away from?
I'd probably say the Midwest. I mean, I love the Midwest, but a couple of them do have domiciliary residency treaties. So I think from memory, Wisconsin's one of them. New Jersey, or Dirty Jersey, is also another one that's a little bit tricky to try and break tax residency from as well.
Who would have thought state tax residency? I think that'll be a new one for a lot of Australian expats. So they just would not have given any thought to. I don't live in the US. That's it. My obligations are over. But no, you've actually got to escape two in many ways, and then consider all the various tax layers. Look, I think that's a lot for Australians to think about. What about, so I guess flipping it on its head a little bit, Australians in the US with superannuation back home, just your normal retail industry fund, do they have to report those in their US tax returns?
Yeah, so that's also something quite topical at the moment, which a lot of clients have asked us questions on. So there's the need to report them in two specific forms from a US perspective. So the first one is going to be on your US individual income tax return. And that goes back to what we were talking about earlier, being that Australian superannuation isn't really viewed to be a qualifying deferred pension for US purposes. So depending on whether you're a highly compensated employee, meaning that you earn more than 135,000 US dollars, then you're going to have to report the unrealized growth in your super as taxable income on your return. If you earn below that threshold, then you essentially report any contributions that have gone into your superannuation during the period that you're a US tax filer. The other form that you're going to need to report that on is your financial bank account reporting form. So that form is a specific form that goes to the US Treasury. It doesn't have any taxes that are due on them. It's specifically just for disclosure purposes and reporting. But you're going to need to report the maximum balance of your superannuation on your FBAR, or your financial bank account reporting form. And then similar to that, there's another form that goes with your federal return, which models the exact same thing, called the Specified Foreign Financial Assets Reporting Form. So 2 to 3 different places that you need to report superannuation. Some clients come to us and they ask us, wouldn't that be exempt under the double tax agreement between Australia and the US? Can I take it out? Unfortunately not. So there's been a bit of publicity around a case with an individual named John Castro, and his advisors had tried to essentially claim that the double tax agreement would exempt him from being required to report superannuation on his US return. I think in around 2020, the courts came down in the States to say that that wasn't the case, and it actually did need to be reported on the return. So the current market view is that, probably just report it to stay safe and stay out of trouble.
Yeah, I think that's a big shock that a lot of people have, that their superannuation can be taxable and assessable in the US when they move. A lot of people think it's out of sight, out of mind, but yeah, definitely something they need to consider. And what about investment properties? I know in Australia, we have a massive property market. Australians love buying investment properties. How are they treated under US tax?
Yeah, I mean, it's definitely still worthwhile holding on to Australian property. I mean, the market is just so crazy over here. And if you can get into the market, then why not? It's probably worthwhile just considering how that is treated for US purposes. So Australia has a really, really great negative gearing system. So essentially what that means is, if the expenses are outweighing the income that you're earning, you can essentially take any of those losses to offset any assessable income on the Australian side. Unfortunately, the US is not as favorable. So you can only take up to the nil balance on your return, and any of those losses get carried forward until the time that you sell the property. And then at that time, those losses get unrestricted, and you can use it to offset any of the gains realized.
Yeah, I think property is something that a lot of our clients consider to, as you just touched on, to get that negative gearing benefit, when they eventually come back to Australia. It's something that a lot of people don't realize they can maintain. Another thing that we talk a lot about with clients is, and I'm sure you're going to love this topic, PFIC, the Passive Foreign Investment Company. So how do, American expats in Australia, manage that, and vice versa? Like, what are the main things that we really need to know about PFIC?
Yeah, I think PFICs, they get a bad rep. They get a bad rep mostly because the way that they're treated from a US perspective is quite draconian, and the taxes applied are quite punitive. So PFICs are essentially passive foreign investment companies. So they capture things in Australia such as ETFs, managed funds, any investments in companies that have passive assets that are used to earn income. And any that have a lot of passive income as well that's being generated. So I think the rule with PFICs is that if you are an American in Australia that holds them, or if you're an Australian looking to relocate to the US and you do hold PFICs, in the year that you acquire them, there's probably a couple of elections that you can make, which will essentially just reduce the legwork and the compliance burden associated with disclosing them on the US returns. But, you're still stuck with doing a bunch of paperwork anyway. So if there is an opportunity to look at investing in something that gives you the same income yields, but isn't necessarily a PFIC, it's probably worthwhile looking at either, diluting or dissolving your interest in one of them and then reacquiring an interest in something that's a little bit more harmonious with the US tax system. So, if you want to keep them, there's ways to manage them, particularly if you can capture them in the first year that you acquire them. But if not, it's probably worthwhile just liquidating them if you're not too, if you don't have that much of a close preference to keeping them in your portfolio.
Yeah. And as you touched on previously too, there's ways around US domiciled holdings, for instance, as well.
Yeah, correct. So that's a massive sleeper, I think. If you can invest in something that's dual listed or US domiciled ETFs, that's probably the way to go. If they're US domiciled, they're not necessarily considered to be foreign. So you do end up avoiding some of those US tax compliance obligations with all the different investment holdings in PFICs.
Which then I guess raises a whole other series of considerations around capital gains tax. And if you're moving from Australia, then you've probably got a tax bill coming. If you're moving from Dubai or Singapore, it might be a lot easier to shuffle things around, but then you've got lower estate tax limits. I mean, gosh, definitely an important area to seek some advice on.
Yes.
He touched a bit on there around the PFIC rules being quite draconian. What about just missing something, I guess either intentionally, probably more often unintentionally, when it comes to your filing obligations for an Aussie in the US? What are the penalties? Is the IRS forgiving? How does that sort of play out typically?
Yeah, sure. I think there's probably, for Aussies living in the US, the biggest penalty that they might face is actually with respect to misfilings for things such as your financial bank account reporting form or any of those specified financial account reportings as well. So, willful non-compliance with those forms could lead to a flat penalty of $10,000 per form that's missed. So considering they don't really have any US taxes due as a result of filing them, it's the one that you don't really want to miss as much, just to avoid any of those penalties. We often have situations where we do have accidental Americans on the flip side. So they might have been born in the US. They had moved to Australia when they were quite young. They retained their US citizenship, didn't really know that they needed to file a US return. And then now they're years late with their filings. So there are specific amnesty programs that are available, specifically the Streamlined Foreign Offshore Disclosure Program, which Americans living abroad can actually go in if they haven't willfully been non-compliant with their US tax returns. So there is some saving grace out there, but definitely don't miss your FBARs.
Yeah. At $10,000 a form, and on the assumption, and that was 10,000 US dollars, just for everyone
Yes.
listening. That was not, nobody said the wrong thing. On the
Yes.
assumption that your fees are not $10,000 per form, I would suggest that anyone thinking of moving to the US or wondering about it, seek some advice. What about, obviously one of the things that's very topical for a lot of our clients at the moment all over the world, but especially the Australian expats, is the currency movement. Yeah, the Aussie dollar is relatively weak at the moment. We're certainly looking at ways to take advantage of that for our clients from an investment, saving, house deposit, mortgages, etc. But how does that, and perhaps does that impact any sort of tax filing obligations for Australians in the US or vice versa?
Yeah. So I think there's two places where it's going to come to light the most. And these are the places where I think in years where the Aussie dollar is a little bit weaker against the US, that cause our clients a bit more stress. It's essentially in the areas of superannuation and principal repayments on any non-US dollar denominated loans. So if we look at principal repayments, for example, the US is really going to view that as an individual investing in a non-US financial asset. And so if the Aussie dollar is a lot stronger when you actually took out the loan in comparison to when you're making that principal repayment, the US is essentially going to say that it's costing you less US dollars to service this foreign asset. And so what that means is they're going to want to take a chunk out of that income gain that you realized, even though you may not actually have realized that income gain. Likewise with superannuation, because we're actually reporting that on the returns in US dollars, then the foreign exchange movement between the Aussie and US currency is going to impact what goes on the return. So in some years, you may end up having your superannuation realizing a loss, but as a result of the FX movement, the net result turns out that you actually make an income gain that needs to go into your return. And then again, you'd end up paying US tax on that as well. So those are the two biggest areas that we see come to light most frequently when it comes to FX gains and losses between both currencies.
Gee, how to make a bad year worse, have a loss on the market and still corporate tax.
Yeah. I mean, 2019 was pretty bad. Yeah, indeed.
So what proactive tax planning strategies can expats use then to really minimize their tax liabilities in the US?
Yeah, I think the first one is making sure that you do actually pay your Aussie taxes. You just don't want to miss out on any credits available if you can get them. Definitely investing in something that operates harmoniously with the US. So for example, blue chip shares, that's probably something that we see a lot of clients choosing to invest in a lot more because you'd probably get the same income yields in comparison to ETFs. And then also making sure that if you do have structures in the mix, if you can get in there early and make sure that you're consulting with dual qualified advisors prior to actually, hitting the red button and all systems are go, it'll probably save you a lot more in US tax compliance fees, particularly if you've got US citizens who are involved in such structures as well.
I think that's a great piece of advice. And I think we've touched on a lot in this podcast. There's lots of aspects to be considering and lots of ways that you can be proactive and timing things a lot sooner is definitely a big one of that. Do you see any upcoming changes, in the US or the Australian system, even maybe getting out the crystal ball? Is there anything that you anticipate potentially happening?
I mean, President Trump does have a way of bringing taxes to the forefront each time he's in office. So there's been a lot of talk in the media recently about letting go of, birthright citizenship. How that eventually translates is potentially US individuals individuals in general who are born in the US. If that goes into place, then they may not have to comply with any of those obligations to file going forward. The other thing that's quite at the forefront at the moment is that a lot of the tax reforms that he implemented the first time he was in office are due to sunset in 2025. A lot of them did actually provide concessions to high income earners. One in particular was in respect of, US estate tax, which is often a political football depending on who's in office. So there are a lot of things that are sunsetting at the end of this year, which we think that hopefully President Trump is going to come out with something different. But it really just depends. I think his biggest focus at the moment is on tariffs, which are probably is outside of the realm of individual taxation. So it's more so a watch his space.
Yeah, but as you touched on, he's a very spontaneous man. So you never know what's around the corner. Well, Noelle, it's been absolutely fantastic having you on the podcast today. I've just got one final question. What do you think is the best piece of advice that you could give, any expat trying to navigate the complexities, of the Australian and the US system? Best single piece of advice that you'd have?
I'd say get the right advisors up front. So a lot can be done prior to moving to the US and then likewise prior to relocating back home to Australia. So it's definitely worthwhile seeking advice before you go, whether it's with pitcher partners or somebody else. It's worthwhile just getting the advice up front.
Comes back to that old saying, if you fail to plan, you plan to fail.
Exactly.
Yeah. Well, as we said, thank you so much for jumping on the podcast today. There's lots to unpack there. The US-Australian tax relationship is very, very complex. I think the IRS, I would argue, probably one of the most complex tax systems in the world. So it's great to get your expertise here on all of these questions that we've been able to ask today. I'm sure our listeners are going to love, taking this deep dive down that path.
It was a pleasure. Thank you so much for the opportunity, guys.
Well, I did prior warn all of our listeners that was going to be a very in-depth interview there with Noelle. And as I said, it definitely was. We covered off a lot from how the IRS penalize you and taxes, PFICs, and you name it. Definitely an interesting one to probably re-listen to a few times, I think, because there's definitely some golden nuggets in there. Now, as we mentioned in our first episode, we will be releasing an episode of the podcast each month on the last Wednesday of the month. In every single episode, as always, we will be interviewing an expert, topics ranging from, as we just touched on, US tax to estate planning, preparing a will, buying property, selling property, you name it. As always, too, if you guys ever want a specific topic, please reach out to us. We're more than happy to find an expert in that field, interview them, and you guys being the listeners, it's really important to us that we're bringing to you the content that you want to hear. The podcast is on all major hosting services, Apple Music, Spotify, YouTube, you name it, you'll be able to find it. As always, please subscribe and check out any other resources we send out as well.
Fantastic. Thank you, Will. And yes, please do follow us on all of the social channels. We're at Money Side Up. Shoot through your questions, comments, feedback. And please do tell other people if you're finding value from this content, from the podcast, enjoying listening to the guests, to the experts, please do tell someone else. Our goal with this obviously is just to continue to educate, to empower, to share the right information and make sure that, we're not just getting worried about myths or noise or anything else, but actually dispelling what this actually means for Aussies all over the world. So check us out on the social channels, follow, leave us a review. Any compliments, you can shoot through to myself. Any negative feedback, shoot through to someone else in the team. But as always, huge thank you for giving us your time today. It's been wonderful to have you join us, and we look forward to seeing you in the next one.
See you next time, guys.